Determination of dividends paid out of retained earnings in line with the provisions of the Finance Act of 2019. Dividend income, okay, is the profits distributed by a company to its shareholders in proportion of their respective shareholdings. Dividend income is the profits distributed by a company to its shareholders in proportion of their respective shareholdings. Okay, so prior to the Finance Act of 2019, the provisions of section 19, the provisions of section 19 of SITA, okay, was where a dividend is paid out of profits on which no tax is payable due to probably there is no accessible profit, okay, due to no accessible profit, or accessible profits being less than the dividend paid, okay, or accessible profits being less than the dividend paid. Okay, so accessible profits being less than the dividend paid. So the company paying the dividend shall be charged to income tax at the rate at the appropriate rate on the dividend. Okay, so where appropriate, as if it were its total profit for the assessment year to which the account from which dividend was declared relates. Okay, so don't worry, we will take an illustration to explain this better. However, the Finance Act of 2019 as it excludes the following classes of dividend from the treatment of section 19 of SITA. Okay, and these are: one, dividend paid out of retained earnings. Dividend paid out of retained earnings. Okay, so now the dividend paid out of retained earnings of a company will be excluded or exempted from the provisions of section 19 of SITA, provided that the dividends are paid out of profits that have been subjected to tax under the Companies Income Tax Act, Petroleum Profits Tax Act, or the Capital Gains Tax Act. Okay, so this is the condition. Okay, so for dividend paid out of retained earnings of a company to be excluded from the provisions of section 19 of SITA, of Companies Income Tax Act, which provides for the FRS to determine the turnover of a company, okay, to determine the accessible profit of a company using the dividend basis approach. Okay, so it's only when the company has suffered tax in line with the provisions of Companies Income Tax Act, Petroleum Profits Tax Act, and Capital Gains Tax Act. Okay, so also dividends paid out of all tax exempt incomes. Dividend paid out of all tax exempt incomes pursuant to the Capital Gains Tax Act, Petroleum Profits Tax Act, and then the Industrial Development Income Tax Relief Act. Industrial Development Income Tax Relief Act, IDITRA, okay, or any other legislation Also, all franked investment income are under the Companies Income Tax Act, under the Companies Income Tax Act will be exempted, okay, or are all exempted. Then lastly, okay, distributions made by a real estate investment income. Distribution made by real estate investment company. Okay, so frank investment income are dividends, okay, or any income such as interest and dividends that have been subjected to tax at source, okay, of which tax has been deducted or withheld at source. Are we together? So this type of income should not be subject to further tax in the hands of the beneficiary. Okay, so distribution made by a real estate investment company to its shareholders from rental or dividend income received on behalf of those shareholders is excluded from the scope of section 19 subsection 1. So it should be noted that the exemption still applies whether or not where the profits that generated such dividend are accrued in a year other than the year in which the dividend was paid. So now let's look at an illustration to get another to have more understanding of this. Okay, so now let's take an extract financial statement of Starry Gold Limited and then Kashi Limited. Extracts of financial statements of Starry Gold Limited and then Kashi Limited. Okay, and Kashi Limited. Are we together? Sorry. Okay, so sorry, we have an illustration. Starry Gold Limited, Starry Gold Limited, and then Kashi Limited. Okay, so the extract of the financial statement of these two companies are as follows. We have total profit or loss for the year. So in the case of Starry Gold reported a profit of say 4 million naira. Okay, and Kashi reports a loss of say 1.5 million naira. She reported a loss of 1.5 million naira. Starry Gold Limited retained earnings brought forward amounts to retained earnings brought forward. This profit or loss, okay, retained earnings brought forward is about let's say 5 million naira. So you have Starry Gold there. Profit or loss 4 million naira. Retained earnings we have 6 million naira, and for Kashi we have just 3 million naira. So these two companies paid dividend. So they paid a dividend declared in 2020 in what in 2021. Okay, so this company paid a dividend of 5 million naira, and then Kashi paid dividend of 2 million naira. Okay, so from these extracts of financial statements, out of the dividend of 4.2 sorry, out of the dividend of 5 million naira, okay, paid out. Okay, so one could conclude that it is 4 million. Okay, 4 million is related to the profits for the year, while 1 million naira uh, is being paid out of the retained earnings. Okay, so in this case, only what only this 4 million naira, okay, shall be subject to the application of section 19 subsection 1 of SITA. Okay, that is, it will be what it will be taken as the profit for the year. Okay, and it will be subject to tax accordingly at the appropriate rate. So if this company turnover for the year is above 100 million naira, then it will be subject to tax at the rate of 30%. Okay, and in the case of Kashi, nothing will be added back. Okay, because one can conclude that the dividend is paid out of the what? Out of retained earnings as the company incur loss in the current year. Hence, these amounts will not be subject to the application of section 19. Are we together? Okay. So that's that.